Charlie Munger, Disastrous Economic Assessment. Charlie Munger, born in 1924, is Warren Buffett's vice chair and second-in-command. Buffett is a well-known investor and the CEO of Berkshire Hathaway, an Omaha, Nebraska-based company with a market value of $354.6 billion. Munger is not only an independent director of Costco Wholesale Corporation, but also the chair of the board of the Daily Journal Corporation. This Los Angeles-based legal publisher sells automated court reporting software. He was the chair and CEO of Berkshire Hathaway subsidiary, Westco Financial Corporation, from 1984 to 2011. At the Daily Journal's DJCO annual meeting earlier this year, billionaire investor Charlie Munger, who works with Warren Buffett at Berkshire Hathaway, said, "The markets are in a lot of trouble. We're creating awful waste and danger for the country. Everyone likes it because it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. That's how it's usually worked in the past. Eventually, there will be a lot of trouble because of the awful excess." He explained what wretched excess meant to him. Undoubtedly, the big squeeze at GameStop, GME, was a terrible waste. Yes, the Bitcoin BTC USD thing could be a better use of time. Venture capital is throwing around too much money too quickly, and there's a lot of waste in venture capital and other forms of private equity. What we're doing now has never been done before. We know from what's happened in other countries that trying to print less money leads to terrible problems. We're closer to terrible trouble than we've been in the past, but it may still be a long way off. Even though the SPDR S&P 500 Trust ETF NY Circa SPY has lost 8.57% since that meeting, it hasn't had the considerable trouble that Mr. Munger was talking about. But it's clear that the awful behavior has continued in the months since, and its signs have also worsened. Even though the crypto bubble has continued to burst, Bitcoin is down another 56% since Mr. Munger's comments. GME is still worth a lot. We can also see that interest rates are still close to their all-time lows, even though they've gone up a lot in recent months, and that the highly inflated money supply has stayed mostly the same since Mr. Munger spoke. We can also see that market indexes and especially housing prices are still high. But the effects of all this overspending and bubble-like behavior are starting to show, with GDP falling for 2 quarters in a row and inflation rising to levels not seen in 4 decades. In this video, we'll discuss what this means for the SPY and how we should invest in the current market. The first implication is forward returns will probably not be very good. In light of current macroeconomic and market conditions, the most important thing to take away from Mr. Munger's comments is that future returns for the SPY are likely to be weak. The reasons are pretty easy to understand. Reason number 1. The outlook for economic growth could soon be assertive, or better. If the economy isn't growing fast, earnings growth will also be slow. Reason number 2. The valuation multiples are higher than averages from the past. Based on data from the past, the yield curve, Buffett indicator, PE ratio, interest rate, margin debt, and S&P 500 mean reversion models from current market valuations show that the market is currently at the upper end of the fairly valued range. This means that it's almost overpriced, which means that returns on the market are likely to be lackluster, if not wrong, for the next few years. The yield curve, Buffett indicator, PE ratio, and S&P 500 mean reversion models all say that the SPY is overvalued. The interest rate model says it's slightly above fair value, while the margin debt model says it's slightly below fair value. Reason number 3. Interest rates are likely to increase even more, based on how high inflation has stayed and what the Federal Reserve has said recently. According to the interest rate model, if interest rates go up shortly, it'll make the market look overvalued. This will add to the argument that the market is overvalued right now. Higher interest rates will also pull down the prices of assets, just like gravity. When growth is slow, multiples don't grow, and may even get smaller. Dividend yields are low, and interest rates are likely to go up. There aren't many things that can drive stock market returns. The second implication is that volatility will likely stay high for a long time. Interest rates are still meager compared to the past, and much extra money is floating around the world's markets. So there will probably still be a lot of buying on dips, especially if there are signs that inflation is going down, the economy is doing better than expected with the current headwinds, or the Federal Reserve is starting to change its hawkish stance. As long as bulls and bears continue to fight aggressively, with bulls buying dips and bears selling rips because they're worried about a recession or more interest rate hikes, volatility is likely to stay high. In addition, geopolitical risks are rising in East Asia, the Middle East, and Eastern Europe, so plenty of other things could send stocks tumbling at any time. Third, it's likely that the market will crash. As mentioned in the second implication, a market crash is a genuine possibility. It's easy to understand why. As has already been said, valuations are already too high, so a crash would be okay without a big change from valuations in the past. After the entire artificial stimulus from central bankers over the past decade, the financial markets might need a crash to return breakouts are normal. Many things could cause a market crash. They seem more likely now than at any time in recent memory. A Chinese invasion of Taiwan, a nuclear war in Europe, a major energy crisis if a fight breaks out between Iran and Saudi Arabia, a massive cyber attack that messes up the global economy, a major new pandemic or a new version of COVID-19, or even a major earthquake. Lesson for investors. Even though investors are having a hard time, if not a very hard time, navigating the markets right now, we're still fully invested. During this time, however, we're keeping in mind the following rules to help us act more wisely. We're being picky by only investing in securities with a clear margin of safety, keeping a small weighting in our most cyclical positions, and putting more money into our most defensive positions. We aren't taking on any personal debt during this time, so we don't have to worry about losing a lot of money if the market crashes. This also allows us to build some dry powder to make money if the market crashes. We're also investing in securities that do well when there's a lot of market volatility because we think that even if there isn't a full-fledged market crash, geopolitical and macroeconomic worries are making the markets more and more nervous, and this will likely continue for the foreseeable future. For those who want to keep investing in low-cost index funds like SPY, we're not bullish in the short term because, as this article explains, we expect weak economic growth, high valuations, rising interest rates, and the growing risk of a black swan event to keep broad market total returns low for the foreseeable future. We tell investors that they should be more selective and not just buy everything in the current market. At the same time, people committed to passive investing over the long term are likely to be happy if they stay fully invested, use dollar cost averaging consistently over the long term, and manage their money well. Because of this, we currently have a hold rating for the SPY. Charlie Munger finally predicts a big crash of markets and disastrous economic trouble by saying that because all those problems are real and so tempting to get rid of debt by just giving Guy a non-interest bearing account, not only do we have a serious problem but solution to it. The easiest for politicians and Federal Reserve is just print more money and solve the temporary problems that way. That, of course, creates long-term dangers. We know what happened in Germany when the Weimar just kept printing. The whole thing blew up. All this stuff is dangerous and serious. You don't want to have a bunch of politicians doing whatever's easy. And on theory, didn't hurt us last time, so we can double and do it one more time. We know what happens on everlasting doubling. Doubling, doubling. You'll have a very different government if you keep doing that enough. So you're flirting with danger somewhere unless there's some discipline in the process. But I don't regard Japan in some terrible danger. They've done a huge amount of this and gotten by. I don't think we'll be as good at handling our problems as Japan is. Charlie Munger. Based on how things have been going in the past, his prediction is almost certain to come true. This should wake people up to the fact that inflation is a long-term threat to savings accounts that aren't invested in assets. Many of his warnings are about inflation and how it makes the government less stable. There's a lot to consider for every investor. This was all for you to understand the biggest threat to the markets. Remember to subscribe to this channel and press the bell icon before leaving.